Hello, everyone, and thank you for joining us today. My name is Stephanie Greiner, and I'm with Refinitiv's Portfolio Analytics Solution Consulting Group. And co-hosting this webinar with me today is Dan Sinreich, Managing Director with MSCI. And before we get started today on the material with risk optimization and portfolio stress testing, there's a few housekeeping items that I'd just like to go over. First, there is no dial-in for audio. Please use your device sound to listen to the webinar. To click the media player on your screen to enable the sound and video, and please note that Flash has to be enabled on your browser. If, as we go through the presentation, the slides become stuck, please refresh your browser at the bottom of the audience console screen. And if you have any technical difficulties during the webinar, there is a yellow question mark icon that you can click on, and that will take you to technical support for the webinar. If you'd like, you can expand your slide window by clicking the maximize icon or by going to the bottom right and dragging the slide to make it bigger. Lastly, there is a Q&A box in the upper right corner where you can submit questions in this box as we go through the webinar. We're going to answer as many questions as possible in the last 10 to 15 minutes. If we run out of time, we'll be sure that all of your questions are answered by way of email. We are recording this webinar, and you'll receive an on-demand link at some point after the completion. Obviously, if you'd like to re-listen or if you'd like to share that link with colleagues that you may think would be interested. So now let's get on to the actual topic of the webinar. Just by way of background, Refinitiv offers industry-leading content, data, and analytics to investment professionals through our portfolio analytics suite of products. MSCI researches, builds, and maintains industry-leading risk analytics, including BAR's multi-factor risk models and risk metrics simulation risk models. The partnership with Refinitiv and MSCI has enabled the true integration of MSCI's BARA and risk metrics models into Refinitiv's Eikon portfolio analytics offering, which creates a powerful combination with best-in-class portfolio analytics. So now I'd like to turn it over to Dan, who'll discuss portfolio optimization and stress testing. And after Dan's complete, what I'll try to do is take you through a demonstration within Eikon so that you can see these tools and how they work in action. So Dan, turn it now over to you.
Great. Thank you very much, Stephanie. Appreciate the introduction. So before we start here, we want to be a little bit interactive, and we have a poll for you. If you could just choose here how you describe your institution, whether an asset owner, asset manager, bank, hedge fund, insurance. We'll just leave it open for maybe 10, 15 seconds here as people submit their replies, and then we'll see what the results are. And what this will do, this will help us tailor our comments to the audience a little bit. So I'll give it another 5 seconds here, and then we'll see the results. So let's look. Okay, so it looks like most of you here are in the wealth space, asset managers second, and then asset owners and banks following along. Great, thank you very much. So look, we'll talk here about really the first components of the investment process, meaning the researching and building phase, how we test portfolio construction, and how we rebalance and reposition portfolios. There's certainly pieces in attributing returns and then reporting those returns and communicating with clients. But for now, really, where optimization and stress testing fit in is really in the first phase, which is really a circle onto itself around researching, testing, and rebalancing. So let's talk a little bit about optimization, and to set everybody on the same level, let's have a high-level view of what is optimization. So very simply, an optimization takes a portfolio, it takes a benchmark, it takes a risk model, expected returns and other asset characteristics and constraints around those asset characteristics, and for our purposes here, it produces an optimal portfolio, and it'll also produce a trade list if there's the existing portfolio, if there's already an existing portfolio. In our case here, we will look at the maximum return and minimum risk. That's our definition today here for an optimal portfolio. There's others, but it's either an absolute space or an active space. So what is a maximum return, either total or active, a minimum risk, either absolute or tracking error, if we're using a benchmark, and subject to any constraints and penalties that I may put together. One interesting thing to comment here on the universe, which is on the left side, the universe typically is an index or a set of companies that are chosen. It doesn't have to be a totally quantitative process, and we'll talk about this later. That universe can be a set of bottom-up selected companies that are attractive for various reasons, and those reasons could certainly include attractive growth prospects found through discounted cash flow methods. But this is essentially just a very high-level view of an optimization. As I mentioned, factor models are an input into the optimization. We at MSCI produce a large number of factor models. Here, we're just showing a typical equity factor model with size, value, growth, quality factors. And the optimizer uses a factor model in order to better produce the optimal portfolio by tilting or by optimizing on certain factors. And it makes the optimization easier than having to tilt on a whole bunch of stocks or bonds or something like that. So the risk model really plays two parts here in simplifying the optimization and allowing the user or the client to tilt either away or towards a certain factor. And these are just some examples here. Typical optimization use cases, really, it's factor hedging, index tracking, and tax aware are probably the main ones. Long short hedging as well. In a factor hedging use case, you tilt a portfolio either away or towards an expected return driver. In fact, Stephanie will show one with growth later on. I will show one where we will tilt toward tracking error. So that's a factor hedging portfolio. Index tracking, you're trying to track a specific index with minimal or a desired tracking error. And it also goes into minimizing transaction costs. And in fact, actually, the example I'll show will sort of combine the factor hedging and the index tracking a little bit. Tax aware, it's a large use case to produce the optimal after-tax returns. So what are portfolios? How can I create portfolios where I minimize the after-tax impact or the tax impact to my client using optimization? So this is where you trade off capital gains and losses as appropriate. And long short hedging is very similar to factor hedging, but it really has to do with using leverage to really tilt away or from a desired investment thesis. There's additional use cases here, targeting certain fundamental ratios, targeting ESG scores. We'll use actually an ESG constraint in the sample optimization. I think it's important to know that there's like I said, many different types of optimizations. Here we'll focus on the standard mean variance optimization, where we minimize risk for a maximum return, and I'll give you a visual of that in a second. But there's all sorts of types out there around risk parity, so trying to have a portfolio where risk is equal from different asset classes or different sources. As I mentioned, multi-account optimization. This also is in the wealth space, where you have an individual who may have accounts at different places, and you want to optimize them among those. Many different kinds here, but we'll focus on the standard mean variance type optimization. So let's go through a quick example here around how an optimization can can support targeted portfolio construction. So let's say that I have a goal to construct an optimal portfolio with a similar risk and return profile as the MSCI World Index. So I have a global investor who wants to generally track the index, maybe has a low active risk threshold. That investor perhaps also wants to have fewer assets in their portfolio because the MSCI world has over 1,600 assets. It can be unwieldy to trade all of those. Some people don't want to see so many assets on their brokerage statement. It really depends on the investor preference. And if we're speaking about an institutional investor, whether we're talking about a high net worth, there's lots of different levels of desires there. But they also want fewer assets, but they also want to target a higher ESG score because let's say they're a sustainability focused investor, and they want to highlight that, look, yes, I'm tracking an index, but I also have a higher ESG score. So let's say that's our problem statement. And with the optimizer, you can easily create a set of portfolios along what we call typically an efficient frontier, but you can create several portfolios here that can meet the investor's preference. So here's a very simple example where I've created those 3 portfolios through the optimizer. As you remember before, I fed in the index, the initial portfolio, the universe, the risk model, right? So having fed all those things, I can now create a portfolio that has a tracking error or active risk, which is the third line item highlighted. It's the second from the bottom here. An active risk of 200 basis points. That's the first portfolio. The second portfolio goes to 300, and the third portfolio to 400 basis points. The other thing to note about these portfolios, they all have different number of assets. So over 200 in the first portfolio, down to 60 in the third portfolio. And perhaps the first portfolio is maybe more tilted and more appropriate for an institutional investor, and maybe the third one is more tilted for a retail investor. Either way, we can pick the right profile that meets our investors' needs with the optimizer. The last thing to mention, and it's very important, in each case, all 3 portfolios improve the overall ESG score. So here we're improving the ESG score from a little over 6 to 6.6, so an improvement of 50 basis points. That is a constraint that I put in the optimizer in order to meet that. So this is a very nice example and a very, very high level one of how the optimizer can be used to really tilt portfolios to investor preferences along constituents, active risk, and various characteristics such as ESG. So that's a quick intro to optimization. Before I go to stress testing, I do want to put another poll here, and hopefully you can answer it. It's about how you describe your portfolio construction process and how do you think about it primarily. There's obviously lots of overlap, but do you think of it mainly as a bottom-up fundamental process? Do you think of it as maybe quantimental, where you're overlaying quantitative analysis with a bottom-up process, or is it primarily top-down? Okay. Interesting, and I'll share it with the audience here in just a second. I'll give it maybe another 10 seconds around how you describe your process. It'll be interesting to see here. Okay, good. We have good participation. All right, so going here in 3, 2, 1. So let's see where we are. So it looks like almost half are primarily bottom-up fundamental. There is, it looks like it's actually evenly split in some ways between quantitative and bottom-up in some ways, with the bottom-up, with the quantamental and the quantitative receiving half. So interesting, very good to see that. Okay. So let's go to stress testing and talk a little bit about stress testing here. So stress testing is really core to risk management. It answers probably what is the oldest question in risk management, which is what if? And the what if is the following. What if there's a future state of the world? What then happens to my portfolio of financial assets? Typically, cross asset classes, what happens to my P&L? So we can get there. But to get there, we take a little bit of a detour in the following manner. First, we have to design the scenario. And typically, most people think of a few, a small number of risk factors. They may think of equity returns, they may think of spreads, they may think of rates, they may think of commodities, and things like that. And we'll show you, they may think of sector returns, country returns, but it's typically a small number of risk factors. On the other hand, you might have a portfolio that is very complex, and it may be a global portfolio. So you may have convertible bonds in your portfolio, which are complex to model. You might have bonds from Europe, from China, from Australia, from the US, from Canada. And so all of these types, and you may have equities from global equities. So all of these assets require very detailed risk factors to be repriced. But yet we have the issue that, look, we think in terms of sectors or countries, so we think of small number of risk factors, but really to do a stress test correctly, you have to reprice it at a very detailed level. And that's where the scenario propagation comes into account, and it's really the heart of stress testing, and it's how you map a certain set of these factors, of these small number of factors, to these detailed risk factors that are used for pricing. So let's talk a little bit about this process and about propagation going further. So roughly speaking, there's actually quite a few stress tests. Today, we'll really talk about the first two, which are predictive and historical stress tests. A predictive stress test implies that we are predicting the future. Maybe perhaps there's a better name, but we are implying that we feel that there's that future state of the world, and that future state of the world includes a certain set of market conditions. So we're going to try to predict what happens in that future state and design the portfolio, the stress test accordingly. Historical stress test means that we're going to take exactly what happened in a certain period, so maybe what happened during the great financial crisis, and apply that to today's portfolio and market conditions and see what happens. There's others out there, liquidity, credit. We'll just focus on predictive and historical for now. There's a couple points to make here too that are really important. The pricing models really are the key. We do feel that revaluing instruments is the right way to do a stress test, because there's inherent nonlinearity in a lot of derivatives and a lot of options, and those really need to be taken into account, especially as you do a stress test where you may change the magnitude of your beliefs. In other words, I feel that rates may go 20 basis points at the 5-year, or maybe I believe that it'll go 50 basis points. Well, that effect may have a nonlinear impact on your portfolio, on your assets. No asset class is really an island, and so we believe in multi-asset class stress tests, and I'll show you an example later on. Spreads may impact equities at times, equities may impact spreads, rates impact everything. So there's definitely a place for single factor stress tests to in the scheme of risk management, but overall stress tests really should be multi-asset class. And the nice thing about stress tests is that the correlation assumptions can be flexible. We'll talk about that in just a minute. So quickly here, how do asset managers use stress tests? Really, it's the first item is to understand portfolio vulnerability. So is there a certain part of my portfolio or a certain set of assets that under certain future states of the world are more likely to have a negative alpha or to return less than I would like? And stress testing really lets you do that by allowing you to create that future state of the world, and then start drilling down and understanding what parts of the portfolio are more or less vulnerable. In that way, you can start building hedging strategies for these future market events. If you have a high conviction that that future state of the world will happen, well, then you can place a hedge, again, either for or against, to take advantage of that. And that way, we believe that improves the allocation of capital. You're able to use the capital more effectively in the portfolio management process in order to take on the convictions that you believe. We feel that that's a very important point. So therefore, stress tests really help you build these more resilient portfolios. They help you quantify exposures to changes in these future market conditions so you can understand specifically what happens where. We see many clients using regular stress tests as an indicator of changes in risk exposures. So as I mentioned earlier, you can have single factor stress tests where maybe you just shock the S&P or maybe the MSCI world or maybe a certain key rate or a certain set of spreads. And if you run those over time, and you look at your portfolios, how each portfolio performs over time under these simple stress tests, it can give you a really nice early indicator that, wait a minute, there's something about my portfolio that is now behaving differently. So I'm getting a different result under the stress test over, today than I did, say, last 2 weeks or last few days and so on. And that can really help you nail down what exactly is driving those returns. It's a place to begin. The nice thing about stress testing is that you really do have a high degree of freedom in defining this future state of the world, and you can really set your own correlations. We have many clients who use our models for their correlations. We also have many clients who choose to define their own correlations because they have a certain view that, look, in this future state of the world, the correlations will be like this. They'll be different and they'll be unique, so I can create those. Maybe I'll use the historical ones as an indicator as what happened, but I really have a view that something else will happen. So you definitely have that view and that option with stress testing. So let me give you an example here of how to design stress tests and what we view as certain key principles. When you design a stress test, is really should meet really these two criteria: one, that it should be complete, and two, that it should be consistent. These are probably there's other, but these are probably the two main things to remember. One is that a complete stress test has to identify a unique state of the world. In other words, if you set an arbitrary set of shocks, that arbitrary set of shocks can define very different market landscapes. And I'll give an example in a second with oil, where you can have oil say I believe that the price of oil will go down, but it can go down in many different regimes. So we would say that's a factor stress test. It's a good one to keep track of, but it's not necessarily complete. And I'll show that, and I'll show you an example of that. On the other hand, the stress test has to be consistent. And this is a little bit harder because consistency can be, you can have sort of different types of stress tests that you set up, some that can appear consistent, some that may not appear consistent. But in any case, the key litmus test here is that they should be realistic. So for example, you would not want to create a stress test where you have, say, Spanish spreads and Portuguese spreads moving at wildly different in wildly different directions, and so on. You want to make sure that what you're putting together is plausible and out of. And this is perhaps the hardest one. Just a second. So here's a good example to illustrate these points. We can create a stress test where we say that oil will go down. In other words, that's my thesis. But the question and the issue is that oil can go down, the price of oil can go down for very different reasons. One, that there can be a demand shock out there, meaning that the economy takes a hit, which is not somewhat of what's happening now, and where the price of oil will go down. Therefore, you'll typically have a positive beta to equities like we did in 2008. In 2008, you can see the dark line, which is the oil price and the MSCI World. Those generally had a high beta because, again, the economy being sluggish pushed oil down. On the other hand, you can also have oil going down because there's a supply shock, and this happened most clearly and most as an isolated example. It happened in the mid-'80s, where there was a glut of oil on the market. The price of oil, the dark line, went down, but the economy, the as defined by the MSCI World, kept on roaring, and it did quite well, and you had a negative beta to oil. So this is what we mean that a shock has to be consistent and it has to be complete. So if you're defining a state of the world where oil is down, you also need to define why oil is down, right? Paradoxically, what just happened in the last month and a half was actually a combination of these two things, right? We certainly have the coronavirus situation, and we had the Russia and Saudi issue and their argument, which basically put a glut of oil out there. So sometimes both things can happen, but those are two good isolated examples. So quickly, to finish up, let me just give an example. When we at MSCI will create research-based stress tests, and you can see there's a small link at the bottom with a blog where our research team did a blog in early February on what could happen in the markets due to the coronavirus. We did this in early February before we knew as much as we did today about the impact. So what we did here, we did a stress test. You can read more about it in the blog, but essentially we defined the stress tests in terms of 6 different factors. We did three equity sectors in China. You can see healthcare going up and consumer discretionary and IT moving down. We then had a view on treasury yields, that there would be a move to safety, and then the exchange rate, small change, and then crude oil going down. So this was our thesis, and you can read about it, but I thought I would put this up here as what we would describe as a complete stress test that meets the criteria that I mentioned below around being complete and being paradox-free, meaning being consistent. These are the results of that stress test. We applied it to a 60-40 equity portfolio, and then we grouped the assets into different sectors. And you can see in asset classes, you can see, so treasury bonds benefited, as did pharmaceuticals, as you'd expect, and a number of other sectors dropped, including retailing and so on. So I thought this would be a good example of what we would consider a good stress test and a complete one. And so just to finalize it here before I turn it over to Stephanie, look, these are some do's and don'ts around stress testing at a very high level. It really is a combination of art and science. The science is absolutely the pricing models that have to be rigorous. The data, the market data that goes into those pricing models has to be solid, has to be clean, and it has to be mapped properly. And all those things are sometimes taken for granted, but that's definitely the science part. The art is in the definition. How do you define a stress test? How do you make it complete? How do you make it paradox-free? And then how do you choose how you propagate those using various correlations that are available and different definitions of correlations. And that's where we work with clients to make sure that the art makes sense as well. Some do's and don'ts very quickly. Again, it's important to have a good economic thesis behind the stress test around why something is happening. Don't just say that, yes, this will happen. Think about the entire implication of that. Definitely update stress tests as new information comes along. We've been working with clients to update their coronavirus stress tests from the early February one based on what's happening out there. And definitely think of varying severities of stress tests. And this is really important if you have a lot of non-linearity in your portfolios where just a small change in market conditions can somehow trigger option payoffs or contingent convertible bond swaps to equities and things like that. On the don't side, again, be careful about over-engineering. We did 6 shocks in our stress test. That's roughly a good number. You can certainly go to 4, you can go to 7, you can go to 8. Anywhere more than 10, you start to lose track of how those stress tests are propagated to the portfolios. And communication of the stress test results are almost as important as the stress test results. So if you put in too many factor shocks there, and it becomes hard to see how those shocks were propagated to all of the different asset classes you may have, you lose the efficacy of the stress test, even though it may be a good one and mathematically makes sense. If it becomes hard to communicate, it loses its efficacy. So again, we really recommend being very judicious about the number of stress tests. And again, be careful about incomplete definitions and inconsistent scenarios. And here we say, look, don't over-rely on history. History can definitely be a useful guide. We typically have a lot of clients who run historical stress tests as a guide, but many will also take that base, will take that historical stress test, look at what's in the market conditions, and then they'll update and create predictive stress tests using the historical as a base. So use those together. So so that's my part on the do's and don'ts. One more poll here before I turn it over to Stephanie. Seeing stress testing and how we think about it. This is a multiple choice question. We'd be interested in how you use stress testing. Do you use it really? Is it a regulatory reporting exercise for you and your firm? Is it for risk management? Is it do you actually make portfolio changes based on stress tests? Do you sometimes use it, or do you not use it, or do you just not use it? So let us know. Again, I'll keep it open. I see just a few submissions, so let me give it another 10 seconds, and then we'll see where the results are here. Okay, all right, so going in 5, 4, 3, 2, 1. It's always good to get a larger sample. Being quants, we do like larger samples. All right, here's where we are. So this is actually really interesting. So it's very few regulatory. This probably means that it's a very US-based audience in some ways. We have a lot of regulatory reporting clients in Europe who use stress testing, but good mix here between using it for risk management, actually influencing security selection. That's great, and then some don't. And hopefully, look, after Stephanie goes through and shows the examples, maybe the 35% of you maybe will decide to use the Eikon terminal to stress test your portfolios. So I'll turn it over now to Stephanie to show you how that's done.
Okay, thanks very much, Dan. So what I'm going to do now is take you through, as I said earlier, a demonstration of a use case and how these tools are integrated into Eikon. One of the things I want to try to make evident here is, as Dan spoke through, the use of optimizers and risk models is a highly iterative process, right? You're constantly going back, whether trying to create an optimal portfolio or then stressing a portfolio and creating stress scenarios. That's highly iterative, right? You try it, you test it, you go back, you adjust. And so one of the real benefits of having this all integrated in Eikon is that is all integrated in one place where you can very easily and seamlessly continue to go back and forth and iterate and change and test. So just another comment, what you see here, everything I show you here was produced within Eikon, all integrated within our portfolio analytics offering. Everything was prepared, basically use our web access tool. What you see here, though, I just want to be clear, are screen grabs. The webinar platform just isn't conducive to allowing it to be, the screens to be as visible as we'd like them to be. So on that, so what you see here is I'm able to go into Eikon and go into the optimizer. The optimizer, again, is built right into portfolio analytics. And you can see here where on the left side there, I'm starting with a cash portfolio. I have a portfolio, all it has in it is US dollar cash. I've been able to set my benchmark, which is the MSCI World Growth. And then, so now I have just those two things in there. And now I'm able to maneuver the optimizer and set constraints. So I have my trade universe also as the MSCI World Growth. I'm allowing all transaction types. I want to be able to sell the cash and buy securities. And here I can set an enormous amount of constraints, right? There's an enormous amount to pick from. But just to take you through what I've done here, I've said, okay, I want the optimizer to minimize tracking error in this case. I could change that to minimize total risk. That's a user-driven choice. I've set in this example, I've set a cash position weight. I don't want that to be any more than 5%. The number of positions that I want the optimizer to target to get to be between 40 and 100. I've put a growth tilt here, just what I happen to choose for this example. I've used an IBEST long-term growth mean statistic, and I've said, all right, try to target that to be a minimum of 10% and apply that across the whole portfolio. And just to highlight, I happen to choose that IBEST growth measure. But if you look on the left here, there's a whole host of content sets that you can choose to put in as constraints in your optimizer. You just see here, like here, for example, are all the IBEST estimates characteristics. You'll notice there's ESG characteristics. As Dan had said in his example, he used ESG as a factor to focus the optimizer on. You could also do that here, right? There's a whole host of characteristics that you can utilize to add into your constraint. If I then run the optimizer, it will give me back results as you see here on the screen. Now, I haven't saved anything off. I've just run that using those constraints, and then this is what the optimizer did. So it'll show you on the left what my constraints were and what the results were. So it ended up with 5% in cash. Remember, I wanted it to be a maximum of 5% cash, so it did that. I asked for 40 to 100 securities. It did optimize to 100 securities. I did set a limit on any non-cash securities, no more than 5% in one, so it's anywhere from 0.41 to 5% in each holding. And then, of course, the long-term growth that I set, I can see what the optimized value ended up being. Now, I could be happy with that, or I could say I want to go back and I want to either add other constraints, I want to loosen some constraints, etc. That's where you start to make this a very iterative process. But let's just say, okay, I want to then save that off as a portfolio, and now I want to go run some stress tests analysis on it. So here, just to highlight that I can then take that optimization and I can turn it into a trade list, which is what you see here. And I can, of course, export that to Excel if I needed to bring it somewhere else. And then I said, all right, I'm going to save this portfolio. So I've clicked Save Portfolio. I've given it a name. And now it will be saved and integrated into our portfolio warehouse that is accessed by our portfolio analytics solution. So now that portfolio is available to any of the analytics that we have within Eikon. So I saved the portfolio. And now I'm going to go into the risk metrics section of Eikon. Again, all in the same place, all built within Portfolio Analytics. And I'm going to set a report that's going to allow me to see how this portfolio looks under different scenarios. So the first thing I'm going to set in the report, I want to look at some value at risk. So I choose value at risk as one of the items that I want to have a look at. Here I can set the horizon. I set the horizon to 1 day, the confidence level to 95%. Obviously, these can be user driven. You can change them. And the methodology for the VAR analysis is going to use a historical methodology. So that's one thing I put in my report. The second thing, now I want to do I want to add some predictive stress tests. So, Dan had mentioned, you can shock oil, for example, right? So here is where I'm putting in all of these various predictive stresses. I want to see how the portfolio reacts to that. So the first one I'm going to put in is let's see if the MSCI World Index goes down by 10%. Okay, so I put that one in there. You can see it highlighted in orange there, the MSCI World Index. Then I want to put in something around US rates. So here I'm going to say, well, I want to see what happens if US rates rise across the whole curve by 10 basis points. If you look here on the lower right, you can see that I have the flexibility to make those interest rate changes. I can make them different all across the curve. There's 17 points in the curve where I can make them different. I just chose in this example for simplicity to make it all uniform, 10 basis points. Next, crude oil. Dan alluded to this one. So I want to see, okay, I'm going to add, how would the portfolio react if oil rose by 20%? Just given now we're in a period where kind of oil has taken a bit of a shock. So here we want to see what happens if oil does the opposite and moves back up. And now, lastly, I'm going to put in some historical scenarios. So you see here, Black Monday, that's the one that I've chosen first. I want to have a look at how the portfolio reacts in a similar scenario to the stock market crash of 1987. So I'll put that one in there. And then I'll choose one other. I chose the fall 2008 crisis. So I put that scenario in there. So again, I'm going to see how this portfolio reacted. I'm going to look at the VAR analysis. I'm going to look at these historical scenarios, fall 2008 and Black Monday. I'm going to see how it reacts to a rise in rates. I'm going to see how it reacts to a rise in oil, et cetera. So you run that through. And just one other point here, this list that you see, September 11th, Black Monday, Tech Wreck, fall 2008, these are all MSCI scenarios. And Dan had showed you in his presentation a more recent coronavirus scenario that they set up, particularly China. That one, for example, will be available in Eikon in the next three or so weeks. So the point is, we do constantly work with MSCI and make sure that we're constantly evolving these historical scenarios and adding ones that are relevant as they come. So I go on, I say, all right, those are all the things I want to look at. I don't intend for you to be able to read these numbers. I just want you to see how when it goes and runs that analysis, I can see the results for each of the things that I chose, right? So I can see the VAR analysis. You can see it. I can see the Black Monday analysis, fall 08, crude oil going up 20%, rates going up 10%. If you could look to the right here, you could see the shock to the MSCI World Index. So that's all in one place. Get all of that data and analysis come back to you. And then I just want to show where I've highlighted, just as an analysis, two numbers, and I'll zoom in those a little bit. So for Black Monday in particular, I happen to notice that this portfolio would have had this result, right down a little more than 19%. And then I look by economic sector, and I quickly see of that, almost 35% of it was from information technology. So again, we go back to the iterative nature of doing this. So I say, all right, remember, I'm now going to go back to the optimizer, and I want to adjust my constraints to try to mitigate this a little bit. So what I do is I then, again, still in Eikon Portfolio Analytics, now I go back to the optimizer. You recognize this is the same constraints that I had before, but I'm going to start to add incremental constraints that allow me to particularly align those constraint to an economic sector. So here, I've said, all right, I want to take that long-term growth that I look to achieve, and I'm going to limit that. I'm going to limit that to 18%, particularly for the information technology sector. As an example, I could also say I want to, in general, overall, limit the weight and exposure to the information technology sector. So here's where you can really start to tailor your optimization constraints based on the results that you get from some risk and stress testing. So I make that change. And then I get, again, you recognize this, I get the results, and here I see the added line where it says for the economic sectors, I set that to 18%, and it indeed achieved that. Okay, so now it's made an adjustment. I don't have all those very, very high growth stocks in the information technology sector, as an example. So what I did was I kept going back and forth, and I kept going back and changing and adjusting, and I finally went back into the risk metrics, and I was able to, again, I then saved that new portfolio off again, and I reran that same report with all of those various historical scenarios and stresses, and you could just see after a lot of going back and forth, that total for Black Monday, that number before that was in excess of 19%, now is just in excess of 14%. So again, this kind of never really ends. It's very much a circle, again, an iterative process, but the beauty is it's all integrated in Eikon. Your portfolios are all available to continue to stress on different things, or go back to the optimizer and change your constraints. So at that, I'm going to stop there, and now it's we have an opportunity for some Q&A. Before we get to the questions, just to introduce, we have also with us for the Q&A portion, John DeVito. John DeVito is head of product management for portfolio analytics for Refinitiv. So largely the architect behind the product management of this. So pleased to have John also available with us to answer questions. So Dan, I'm going to open up the Q&A window here, and I don't know if you've been able to highlight a few that have come in, and maybe we can start to read through them.
Sure. So I have, there's a couple here that are quite interesting. So at first one, there's a couple questions around, will we get the slides and will there be a recorded version of the webinar for people? So maybe Stephanie, maybe you can take that one.
Yeah, so that's yes to both. So the recorded version, you will get that link at some point after we're finished, absolutely, for on-demand usage, and these slides will also be made available.
Great, thank you. Okay, here's one. How far does the historical data go? I thought this was a good question. So in our stress tests, the historical data really goes generally to the mid-80s, and I actually think we even have an oil shock back in the late 70s. The issue is that you have to be careful about that because the market was a very different place back then. So, for example, in the mid 80s, right, there was no such concept of a CDS, and so there were no CDS spread curves that we use quite a bit these days in modeling our stress tests. There was no euro, for example, right? So you really start making some assumptions around what do I do with a euro with a euro-based asset. Again, and you have much fewer even issuers of credit back then. So the market was very, very different. And even if you look at, like, say, just my favorite example is Apple. If you look at the history of how the Apple stock behaved back then, and you try to look at it and try to somehow say it's similar to what's happening today, I don't think Apple is a very different company in a very different landscape than in the mid 80s. So the data is there. Again, this is where the science and the art comes in. The data is absolutely there to go back. It's the art is how you use that. And in the historical stress test that Stephanie was showing, we can show you what's in there. We've used that data in a way that we view as very appropriate. But there's always that pitfall with using very old historical data. So I wanted to highlight that. There is another question which, oh, sorry, go ahead.
Yeah, no, Dan,
Okay.
I just was going to pick out this one here. Can you please share the app that you were using and how to get there? So I was using Eikon, and within Eikon, there's an app called Port, P-O-R-T, and if you're an Eikon user, you type that into the search bar, you get to Port, and then within the analytics and reports section, you have the ability to run all of those risk metrics reports that I showed, and also the optimizer is there too. I should highlight that these are add-ons. So if you don't see that, they simply mean that you don't have that add-on. But I was in Eikon and the application portfolio analytics.
Yeah, great, thank you. Here's a couple, and then one I'll need help with. So I think maybe from Stephanie or from John, can you elaborate on the stability of the optimizer solutions and what is the ability to audit the validity of the resulting solutions? I'll comment on the first one, on the stability of the optimizer solutions. This is the same. So the optimizer that's integrated into Eikon is the same optimizer that's used by a fairly large set of the industry to build the top-down equity portfolios. It's very stable. At the very simplest, if you put in the same results with the same market conditions and constraints, you'll get the same. If you put in the same inputs, you'll get the same results. in its very barest. And then we certainly, the optimizer is used to actually run strategies. In fact, the optimizer is used to run some of the ETFs, the MinVol, the USMV, and the ACWI MinVol, and the diversified multi-factor ETFs that are out there in the market. It's run off of the same exact optimizer as what's integrated in Eikon. So it is quite stable, I would say. We can provide more technical details. Just please follow up with me on the ability to audit the validity of the resulting solutions within Eikon. I'll turn it over maybe to Stephanie or John to comment on that.
Yeah, John, maybe I can ask you to take that one. It's okay.
Sure. So as Stephanie said, that we do produce a trade list that produces the optimized portfolio, and then we are in the process of launching a view that will give you the breakdown of all the factor exposures, so that you could see both the initial portfolio as well as the optimized portfolio, and how the exposure to the various factors that are used in the underlying risk model have changed as a result of the optimization that you've performed. And then also see a view of the again the change in your total and active risk along with the from the initial portfolio to the optimized portfolio.
Okay, great.
Thanks,
Thank
John.
You. Yeah, and it seems that there's a. Sorry, Dan. Go ahead.
No, go ahead. No, go ahead, Stephanie.
There's a series of questions. They're all very similar around pricing, and what I showed, and that it's an add-on, and is there. So they are what I showed you, the optimizer and the risk metrics, risk models, scenario analyses, etc. That is an add-on to our portfolio analytics offering within Eikon, and there is an incremental cost to it. So anybody that wants to have specific information for their particular contract or current access, we're happy to follow up with you. But in general, I see a lot of questions around: is it an add-on? Yes, it's an add-on. And is there an incremental cost? Yes, there is an incremental cost.
Great, thanks, Stephanie. Here's one going back to more analytical type questions. I'm just reading them off the board here. So I think this one also has to probably go to you or John. Is there programmatic access to these models? If so, where can we find documentation on that?
There isn't programmatic access to the models. I'm not 100% sure what's being asked here. So I see where the question came from. I'm happy to follow up directly with the person who asked that question.
Okay, great. Here's one on the optimize, another analytical one. If you would choose minimizing tracking error as the goal, trade universe equals index without any constraints, do you get an exact replication of the index? No, not necessarily, because the index has a number of construction rules around it, and the minimize, and it could be that there is a more optimized way to have the same risk and return profile than the index. In other words, it really depends on which index you're choosing, but not all indexes, in fact, most, they are not built to minimize risk and maximize return, and that's what the optimizer is trying to do. So it's not likely that you'll get the exact replication just because of the different risk and return profile. Even if you choose minimizing the tracking error, the optimizer can find a potentially lower risk and higher return way. So that's the situation.
Okay, I see there's a question. Is there an API we can hook up to? John, and I guess also Dan. I mean, I know, what I showed, in Eikon, that's the way this is accessed. Is this
we are not currently we are not offering this capability through an API. No.
Okay, great. Another one, will recording be made available? Yes. Another question came in on that. We definitely will make the recording available. I'm just looking through the questions here. Okay,
can it be used with Canadian? Can it be used with Canadian mutual funds?
So
I think this goes to Can we run any mutual funds or Canadian mutual funds specifically through the optimizer or through stress tests?
We do handle funds in both the optimizer and in the risk offering, the stress testing offering.
Great. Another question, how supportive is the optimizer of risk parity portfolio construction? So I'll answer it. So I'll take a shot, and again, I'll turn it over to John and Stephanie. Absolutely, it is. It's a typical use case for the optimizer, for the MSCI optimizer that's integrated. The question is whether those doors and those settings are turned on within Eikon. So I'll send that to John and Stephanie.
Yeah, so currently the two sort of use cases that we support are the ones that Stephanie mentioned, where it's minimize total risk, minimize active risk. But this is essentially our first iteration, and certainly we want to broaden out the use cases that we want to cover, and that's certainly one of them.
Great, thanks, John. Here's another one. What types of ESG data can you introduce into your optimizer? Stephanie, maybe you can talk about what's there in Eikon.
Yeah, I mean, basically, we have a robust set of ESG data, quite robust, and all of it is made available and accessible in the optimizer. So if you're utilizing or looking at an ESG content anywhere, you would be able to introduce that into your optimizer and set a constraint for it or a tilt toward it. So everything that's available elsewhere with regard to ESG can be utilized in the optimizer.
Great, thank you.
Okay, I think, Dan, we have we've gotten through all of the questions, and I see it is 1 minute to the hour. So perhaps I'll just close it up. So just real quick, this is a series. These webinars with Refinitiv and MSCI, the first of a series of at least 3, and the next one is June 4th, and we hope to see you all again on June 4th, where we're going to go very much into the detail on the logic of creating custom scenarios. Right, what I showed were scenarios available within, but you can of course create your own custom scenarios, and we're going to go deep into that, and then testing those scenarios and the best practice for testing those scenarios for validity. So we do hope to see you on June 4th. There is there's a free trial opportunity that you can click. There's a button on the left. So please feel free to do that if you're interested. And lastly, you'll be prompted by a survey page, and we do obviously very much appreciate your feedback. So if you have time, if you could give us some feedback on the survey after the webinar is complete, that'd be very much appreciated. And if that, I think we will close out the webinar, and thank you very much to Dan and to John and to everybody who joined. Thank you very much.
Thank you.